Welcome to this explainer. Today, we're focusing squarely on the ACCA Financial Management exam. Specifically, we're digging into Chapter 5 of your syllabus, Relevant Cash Flows. Now, if you're already studying for your FM exam, you probably know that capital budgeting is a heavily tested area, and honestly, it carries incredibly high stakes. Getting the project cash flows right is literally the foundation of everything, both on your exam paper and in the real world. Think about it. If you calculate this amazing net present value, but you base it on the completely wrong cash flows, you aren't just losing exam marks. In a real-world scenario, you'd be making a disastrous multi-million-dollar mistake for your business. So let's make sure we master exactly how to isolate the right numbers. Okay, I want you to put yourself directly into the mindset of the examiner for a second. Out of that massive wall of financial data they're going to throw at you in a scenario, which cash flows actually belong in your project appraisal? Well, to figure this out, we're going to use a concept I like to call the relevancy filter. You can think of this filter like a really strict security checkpoint. Every single number from the exam question has to be evaluated here, and only these specific, truly relevant cash flows are allowed to pass through into your final calculation. Here is our roadmap for today. We'll start with the relevancy filter rules, then move into navigating cash flow traps. After that, we'll look at the reality of taxation, follow it up with tax-allowable depreciation explained, and finally, we'll tackle the financing exclusion trap. All right, let's dive into part 1, the relevancy filter rules. Every single data point has to pass through 3 incredibly strict criteria. First up, it must be a future flow. Look, we can't change the past, right? So anything that has already happened is completely irrelevant to a future decision. Second, it must be incremental. This means we are only looking at the extra cash flows that occur strictly because we decided to go ahead with this specific project. If a cost is going to happen anyway, it doesn't pass the filter. And third, it has to be cash-based. We're tracking actual, physical money moving in and out of the bank account, not accounting fictions. If a number fails even one of these 3 criteria, you leave it out. Otherwise, you're going to fall right into the classic garbage in, garbage out trap, which will completely ruin your final net present value calculation.
Moving right along to Section 2, Navigating Cash Flow Traps.
So we need to draw a hard line here between what gets tossed out of our filter and what hidden factors absolutely have to be brought into the appraisal. On the exclude side, we've got sunk costs and non-cash items. These are essentially decoys designed to waste your time because, examiners do have a wicked sense of humor. But over on the include side, we have opportunity costs and cannibalization. These are the sneaky, hidden realities of business. They aren't always printed clearly on an invoice, but they have a very real incremental impact on your company's actual cash position. Let's look a little closer at opportunity costs. Imagine your company owns a warehouse. If you proceed with a new manufacturing project, you're going to need to use that warehouse. But wait, if you didn't do the project, you could have actually rented that warehouse out to a third party for, say, $50,000 a year. By choosing to do the project, you are actively sacrificing that rental income. That lost income? That's an opportunity cost. It totally passes our filter because it's future, it's cash-based, and it's incremental to the decision. So you must include it as an outflow or a cost to the new project. Then we have cannibalization. This happens when a new project starts eating into the sales of your existing products. Let's say you launch a shiny new deluxe widget. It's going to generate $1 million in sales, which is fantastic. But because it's so great, 20% of your current customers stop buying your standard widget and just buy the new one instead. So you haven't actually gained a full $1 million in new value. You have to subtract the lost contribution from those standard widgets. That lost cash flow is cannibalization, and it is highly relevant. On the flip side, and I literally cannot stress this enough, I need you to completely banish sunk costs and standard non-cash depreciation from your analysis. Banish them. If the exam question says $50,000 was spent on market research last year to evaluate this project, just ignore it. That money is gone. It's a sunk cost. It is definitely not a future cash flow. Similarly, standard accounting depreciation is just a bookkeeping entry. It's just a way to allocate the cost of an asset over its useful life. Nobody's actually writing a check for depreciation. It is purely non-cash, so banish them both. Let's move on to Section 3, the reality of taxation. You simply cannot ignore the tax man when it comes to capital budgeting. You absolutely must be able to recreate the precise structure of calculating tax liabilities on operating profits. Basically, you'll take your relevant revenue, subtract your relevant cash operating costs, and arrive at a net operating cash flow. The examiner will give you a tax rate, let's say it's 30%. You apply that to the operating profit to find your tax liability. But here is the kicker. Pay very close attention to the timing. The exam might say tax is payable in the same year, or it might say tax is payable 1 year in arrears. If it's in arrears, the tax for year one's profits doesn't actually get paid until year two. That timing shift drastically changes your discounted cash flows, so you have to map it out methodically, year by year. Next up, Section 4, Tax-Allowable Depreciation Explained. Okay, there is a vital difference you need to understand right here. Just a moment ago, I told you to completely banish standard depreciation because it's a non-cash accounting fiction. But tax-allowable depreciation, which is often called capital allowances, is entirely different. While the allowance itself isn't a cash payment, the tax authority actually allows you to deduct this amount from your taxable profits. And by lowering your taxable profit, you are lowering your actual tax bill. That tax saving is very real cash that gets to stay in your bank account. So standard depreciation? Exclude it. Tax-allowable depreciation benefits? Definitely include them. To make sure we capture those tax savings, we can break down the rather dense life cycle of tax-allowable depreciation into a simple 3-step checklist. Step 1, writing down allowances. Every single year you own the asset, you calculate a percentage of its value to deduct from your taxable profits. Step 2, balancing allowances. At the very end of the project, if you happen to sell the asset for less than its remaining tax value, you get a final bonus deduction to balance the books. That creates a really nice tax saving. And finally, Step 3, balancing charges. Now be careful here. If you sell the asset at the end for more than its remaining tax value, it means you've claimed too much previously. The taxman will hit you with a balancing charge, which increases your taxable profit and costs you extra cash in that final year. And finally, Section 5, the financing exclusion trap. I really want you to memorize this powerful anchor rule right now. Never include interest payments or dividend payments in your project cash flows. Never. For sure, you will see a line item in the exam question that says something like, the project will be funded by a loan with $10,000 in annual interest, and your first instinct might be to treat that as a future incremental cash outflow. Don't do it. We exclude it completely. Why? Because the discount rate handles it. Let's talk through the core logic as to why we actually do this. In capital budgeting, we calculate our net present value by discounting our cash flows using the company's cost of capital, often the WACC or weighted average cost of capital. That percentage rate already includes the cost of the bank loan, the interest, and the cost of equity. It already perfectly reflects the burden of financing. If you were to put the interest payments into the cash flow table and then discount those cash flows using the cost of capital, you're punishing the project twice for the exact same cost. You're double counting. So, bottom line, keep financing costs completely out of your cash flows. Well, we've covered a ton of ground today. We established the rigid rules of future, incremental, and cash-based flows. We learned to confidently banish sunk costs and welcome in opportunity costs. We mapped out tax schedules and unlocked the cash benefits of tax-allowable depreciation, all while dodging the dreaded financing double-counting trap. If you apply these frameworks rigorously, you're going to isolate the right numbers every single time. But remember, the relevancy filter is just your first line of defense. How you discount these flows will ultimately decide the project's fate. So what do you think? Are your discount rates hiding traps of their own? Thanks for joining me on this explainer, and good luck with your continued exam prep.